Silicon Valley Bank, which was founded 40 years ago with the aim of catering to the needs of fledgling tech companies, grew to become the 16th largest bank in the United States. However, it suffered a catastrophic collapse in just a day and a half, making it the second largest bank failure in U.S. history. Once considered a significant player in tech banking, SVB's shocking downfall led to the closure of other banks, sent shockwaves through global markets, and put startups across the country at risk of failure. What led to this dramatic turn of events? SVB had built a significant clients comprising nearly half of the country's technology and life sciences firms that were backed by venture capital. Companies such as Roku and Roblox had invested millions in the bank, contributing to its rise to prominence. However, some of these clients were seen as risky due to their fast-paced nature. When things started to go wrong, they were quick to withdraw their money from the bank, intensifying the situation. This occurred in the aftermath of the banking crisis that triggered the Great Recession. Among all these events, one may wonder about the role of regulators. It appears that in 2015, the CEO of SVB implored policymakers to exempt banks with assets below $250 billion from the tough supervision and regulations of the Dodd-Frank Act. This act was instituted to prevent another financial crisis. In 2018, a bill was passed that weakened the Dodd-Frank Act, fulfilling Greg Becker's wish. As a result, SVB saw a surge in deposits during the pandemic, as businesses deposited more money. In just 2 years, deposits tripled to $189 billion, making 2021 the bank's most profitable year ever. SVB Financial utilized the increased deposits to purchase tens of billions of dollars worth of U.S. Treasuries and government-backed mortgage securities, which are typically deemed safe. People and companies deposited money into their bank accounts, and the banks looked for ways to earn a return on these deposits. They opted to purchase bonds with the funds. Within a year, SVB's securities portfolio grew by approximately $100 billion. However, when interest rates abruptly increased, bond prices declined, and banks like SVB, which had a significant holding in bonds, suffered significant losses. They were now stuck with substantial losses. Soon, the investments that SVB had purchased were valued at $17 billion less than their fair market value. The difference between what SVB had initially paid for these bonds and their current market value had reduced to over $17 billion, which ultimately proved to be the crucial risk that caused SVB's downfall. The situation worsened when interest rates increased, and the bank experienced a decline in new deposits, which dropped by almost $30 billion from March to December of 2022. A vast majority of the bank's deposits were held in only 37,000 accounts, each containing over $250,000, which is the amount insured by the FDIC. On March 8, SVB Financial disclosed in a regulatory filing that it had sold a significant portion of its securities at a loss of around $1.8 billion to offset the decline in deposits. This news caused a lot of anxiety among investors and triggered a substantial drop in the bank's stock price. Adding to the nervousness was the recent announcement by Silvergate, a crypto-focused bank, that it would be winding down and returning all deposits. The timing of these events have been worse, as the market was already on edge due to the failure of another crypto bank, Silvergate, which had suffered a similar issue, however with a higher exposure to the overall crypto market and FTX in particular. However, the underlying cause of SVB's troubles was the same as Silvergate's. The bank had invested heavily in assets that had decreased in value due to rising interest rates. When customers began to withdraw their funds from the crypto market, SVB was forced to sell these assets at a loss, worsening the situation. The mounting losses were irreversible, leading investors to fear insolvency and causing SVB's stock to drop almost 60% in a single day. As this crisis unfolded, many venture capital firms recommended that startup founders withdraw their funds from SVB. To make matters worse, by the end of March 9, customers had withdrawn a staggering $42 billion, causing the bank's cash balance to drop to a negative $958 million. The withdrawals were so intense that they caused the bank's internal system to crash, adding to the fear and panic among depositors. The situation was made even more concerning by the fact that, under the Federal Deposit Insurance Corporation, FDIC, the U.S. government only guarantees refunds up to $250,000. Since SVB was a technology-focused bank, many of its deposits exceeded this amount. As a result, the value of Silicon Valley Bank shares continued to crash until trading was suspended on March 10. The bank tried to raise capital, but their efforts failed. By March 10, SVB began searching for a company to rescue them, but no one was willing to help as the full extent of their problems was unknown, making it a risky plan. As a result, the FDIC stepped in and shut down the bank. This happened in less than 2 days since the crisis began, making it a massive management failure. SVB should have had a contingency plan in place to deal with the rising interest rate environment, even though the U.S. Federal Reserve incorrectly claimed that inflation was only temporary. As investigators explored further into the crash, they uncovered troubling information that the chief risk officer for Silicon Valley Bank left abruptly in April 2022 and wasn't appointed until January 2023, leaving the bank without a risk officer for 8 months. This occurred just as the negative effects of rising interest rates were intensifying, and the bank needed to rebalance its portfolios to adjust for the higher rates. Without anyone to oversee this process, the bank was like a plane without a pilot in the midst of a storm, which is deeply concerning. Just weeks before the decline of SVB, the bank sold a combined $4.4 million worth of company stock. The Securities and Exchange Commission, SEC, filing mentioned that the sale was automated and pre-planned, but it is uncertain whether there was any prior knowledge of the collapse. Additionally, SVB employees received their yearly bonuses, ranging from $12,000 to $140,000, only hours before the official crash. Although we cannot accuse anyone of wrongdoing, it is possible that the bank's executives had some knowledge of the impending crisis. Shareholders are currently suing SVB for fraud, claiming that the company neglected to disclose how rising interest rates could make the bank particularly vulnerable to a bank run. The tech sector will be the most affected industry as Silicon Valley Bank, which is considered the lifeblood of the tech ecosystem, is expected to suffer the most from the crisis. The bank serves as the main source of day-to-day operations for tens of thousands of startups, most of which have negative cash flows and rely heavily on raising capital to pay their expenses. Many of these companies store their capital and use it until the next raise, and if their stored money is taken away suddenly, they could start to fail, resulting in layoffs and eventual bankruptcies. This crisis has affected several companies, including Etsy, Roku, Roblox, Rocket Lab, Circle, Fox Media, and Vimeo. The CEO of Y Combinator, Gary Tan, referred to it that could set back their innovation by at least a decade. The situation has also affected the finance industry's confidence, with U.S. banks losing a combined $100 billion and European banks losing $50 billion in valuation. The crisis has also spread to the UK, where the Bank of England was looking for ways to minimize the damage. The UK arm of Silicon Valley Bank was bought by HSBC for a nominal amount of £1.